Santosh Rao of Manhattan Venture Partners joining in. Santosh, morning, and thanks so much for taking the time. Good evening to you, actually. Uh, what do you make of everything we've seen over the course of this week? And also, I haven't mentioned it so far today, but then we've been speaking about crude oil prices and the way they've plummeted. All of that put together, what does that set things up for? Are we guaranteed a rate cut when the Fed meets later this month?
Yes, thank you for having me. I think that's a given. That's been well telegraphed that he's going to cut this September. The only issue is it going to be 25 basis points or 50? I'm in the camp of 25 basis point because 50 basis point will send an alarming signal that things are really bad. As it is, a slowdown was expected. Things are slowing down, and which is what the Fed wanted. And so now the issue is soft landing versus hard landing. I still think we are in the soft landing camp. Let's see where the data is on Friday. Uh, all signs are the jobless claims and all the job openings and all that are indicating, and then the manufacturing, the PMI index, the manufacturing activity here and in China is also slowing down. So, so generally, a slowdown in the pace of the economy, economic growth. So that's a given. So I think what you're going to see is commentary. It's going to be 25 basis point with the option of doing more if things get out of hand. So at this point, I think he's going to stay the course, 25 basis point, with saying that things are slowing down gradually, which is what he wants.
So we've seen actually some of the major tech companies lose ground. The chip makers also losing quite a bit of ground. Some would say some of the froth is being taken out of the system. What happens when you start seeing interest rate cuts in September? What happens to risk assets, not just in the US, but also in the rest of the world?
Well, interest rates cuts is good for growth stocks. So I think in the broader sense, it's good. So what you're seeing is, don't forget, we are entering September, which is traditionally, historically, very choppy month. There's a lot of tax loss selling. There's a lot of cross currents, people repositioning, and all that stuff. So that also plays into this market, regardless of the interest rates and all this phenomena that we have. But at this point, September is seasonally weak, and it kind of feeds itself. Then you have some big bulls, perennial bulls, saying that the market is going to drop 7% and things like that. So all that, the market is already jittery. We knew evaluations at 21 times for S&P 2004 earnings. S&P is kind of rich in valuation, S&P 500. So I think the market was on the edge. We were expecting earnings to keep growing. We want the economy to be kind of slowing down, but not by much. We don't want it to fall off the cliff. So that's what you're seeing. And to your earlier question about the oil prices, I think that has a lot to do with the supply demand. First of all, I think the PMI data and the Chinese data generally showing that things are slowing down globally as well. Two biggest economies especially, and then you have this geopolitical conflict going on. So I think that's also, plus there's excess supply in the market as well, where US is ramping up, Canada is ramping up, and so many other places are also, Guyana is coming on board. So the supply is not an issue, and excess supply is the issue now. So I think that's a combination of all those events is really pulling the thing down. But if the geopolitical events really explodes and gets worse, you can see an oil price spike up closer to $80 according to some oil analysts.
Okay.
So there's a lot of things, a lot of moving parts there on the oil side. But overall, things are slowing down. Fed wants that, and 25 basis point on the
Okay.
cards.
So quick last question then. What happens to currency? Do we see a weakening of the dollar over the course of the remainder of this year and heading into next year? And what does that do to flows, and particularly flows into emerging markets?
It's good, right? The falling dollar is good for
Yes,
emerging
which is why
markets.
I'm asking.
Uh, yeah, so I think that the interest rate cuts and all that feeds into that. So I think generally, I think a falling dollar is good. It's good for exports for US, things like that. The what do you call the imbalance in the supply export import equation also kind of evens out, gets better. Already, US the deficit has declined in terms of the exports and imports. So that's been favorable, and you're going to continue to see that as the dollar weakens more and more. So that's generally good to some extent. You don't want a weak dollar overall, but to some extent, to adjusting to get the supply demand balance in check. I think it's generally healthy and constructive for emerging markets and the U.S. as well.
Santosh, thanks so much for taking the time, as always, for joining us this early in the morning and late for you, actually. All right.
Thank you. Yeah.